Hey, my name is James Nicholson and welcome to my YouTube channel. I want to thank everyone that watches the channel on a regular basis. We've just hit 400,000 views, which is absolutely insane. Now, we're on the journey to 5,000 subscribers and we're very close to that milestone as well. So if you're not already subscribed, do smash that subscribe button, hit the bell notification. And if you want to help us get more eyeballs on the content, smash the like button as well, guys. So in today's video, I want to talk about what's the benefits of investing in expensive properties as opposed to cheap properties, and what should you focus on. Now, my portfolio is based all around the UK. I've got a few properties in Dorking in Surrey, which is where I am right now. And that, I would say, is where you'll find expensive properties. It's not London prices, but it's not far off London prices. I've also got properties in Hastings, in Sussex. And that, for me, was at a time when I was looking for cheaper properties. And so I looked for cheaper properties that were fairly close to me, so I can get to Hastings in around an hour and a half. So that's a cheaper area. And I also invest up north as well. And I've got investments in London as well. So I've got a portfolio in lots of different areas. So I really can give you a critical view on what you should be looking at. Should you be looking at expensive houses or cheaper houses? Let's break that down. So cheaper houses. Well, the cheapest house I've ever bought was actually one of the most recent properties I've ever bought. And so that was a property up north in Doncaster, which we bought for Georgia, my daughter. We bought that property for £60,000, 60k. And initially it rented out for 575. But if you do follow along on the channel, you'll see that we had a tenancy changeover recently. We're now getting 625 for that property per calendar month, which is pretty good. So that is the cash flow on that one. Now let's look at an expensive property, because we bought an expensive property in the last year as well. So an expensive property. We bought a one-bedroom flat in Dorking. You can see this property on the channel as well. Go and check out the video if you want to see what that looks like. We bought it for 235k and we get 1,100 in rent on that property. Big difference there. So those are the differences there. So let's just look at if we doubled it up, right? So if we doubled it up and we got two of these 60k properties, we could easily find another one and get that for 625. We would now be getting 1,250 pounds rent per month. If we got two of these, another 235. We've got another 1,100. We would get 2,200 in rent. So the rental income would be great here, but we would have invested nearly 500 grand, nearly £500,000 to generate 2,200 per month. Up north, looking at that, we could invest under 250 grand. And in fact, that'd be 120, around 240,000 grand, 240,000 pounds would actually get us the same result. So looking at cash flow, it looks like the north is slightly better, or at least the cheaper houses are better. But what else do we need to consider when looking at this kind of investment? Well, here's the things. The cheaper houses are less likely to go up in value as quick, right? They've probably been cheap for a while. In fact, in Doncaster, you can find house prices have gone up significantly recently, but for a while they didn't go up as much as other places in the country. So generally up north, house prices don't go up as quickly as down south. So the capital appreciation is going to be much lower when you get a cheap house, for sure. That's an important consideration. So down south, house prices do go up quite quickly, significantly faster than they do up north. And so you're going to make more net worth by having a property in the south, an expensive property. So then you've got to look at the pros and cons of both. Do you want cash flow? That's very, very important because that gets you out of your job, right? So if your goal of being a property investor is to leave your job or to have a pension, and you want to have a regular income, then you want to get some cash flowing properties. And this is why I spread my investments around. We've got Dorking, Hastings, London, Doncaster, right? So we've got 4 different areas that we are investing in there. And that means that we get a little bit of both. And so as a property investor, I would say that you should be looking for properties in both areas. My first place that I would start, if I was starting totally from scratch today, I would start looking for some cheaper houses that give you cash flow, particularly in today's market where there's a little bit more uncertainty. Will prices go up or down? It's not so much of an issue if you're buying a house for 60 grand. If the market crashes 10%, are you really going to be that bothered? Well, if you're not looking to sell, probably not, right? It's not going to be a big issue for you. But what's more important is you've got that good cash flow. And if you can get 5, 6, or as many as 10 of these using a strategy called buy, refurbish, refinance, rent, that can then get you out of your job. That's the first step of being a property investor. Then I would take the cash flow from these, I would build some deposits up, and I would find some, again, good investments down south that I can add value to that are going to get the capital appreciation. And that is when you start to get really wealthy quite quickly, because when the price goes up, you can pull that cash out and then you could buy more cheap houses or some more expensive houses. But you need a bit of both, right? So the cash flow from these ones here, from these cheap houses, is not going to be enough to fund lots of these expensive houses. You're not going to get big chunks of money. You can do it once in a while, and then when you've got some money into these assets, those are the ones that are going to make you really, really wealthy. And that's why big investors will invest in London, even if the return on the rental income is lower, because they're banking on that capital appreciation. And so that's what you should be doing, is having a mixed portfolio. Don't put all your eggs in one basket, because anything could happen if the north suddenly had a big crash or unemployment went really high there. You could have issues in that area. But likewise, if you do get hit by a property crash, it's probably going to be your expensive properties where you really notice and feel the pain from that. So that's my opinion on it. I think that you should have a mixture. I think when you're starting out, you should go on the cheaper houses with good cash flow, then start moving into the bigger properties that will give you that capital appreciation. But what do you think about cheap houses versus expensive houses? Comment below and let me know your thoughts. I would love to know what you think. Do like this video if you didn't earlier. Subscribe, help us get that 5,000 subscribers. Maybe it's there by the time you watch this. And do check out all the other content on my channel, including this video right here.